Welcome to the Trading Lounge and the forex report, and starting with the US dollar index here. As you know, we've been looking from wave 3 and working through wave 4 as a completed triangle, and looking for wave 5 to the upside, and looking at targets at the next level past this is a minor level here, 95. The next minor level is at 98. There's an important level at 96.50, so we've got that in mind there. I also just want to chuck a spanner in the works here and just point out that wave 4 corrections can get out of control a little bit in terms of doubling in size and getting more complicated and those sorts of things. It is possible that wave B is actually over here and wave C over here for wave 4. So a larger A, B, and C here for wave 4. I don't think that's the case, but just wanted to put it on the table there. What we would need to see is a collapse of this move here, past the 61.8% from this move to this move here. But as it stands, we're moving to the upside, and this would be the pattern that we're tracking to the upside, and a nice impulse wave for wave 1, an A and a B and a C wave here for wave 2. And I kind of like that it actually shows some strength, because it's a corrective move that is actually sort of, it's like a running correction. It's sort of running up the hill, you know, it's not pulling back here. So it is showing strength, and we would be looking at this working higher in this sort of fashion here, up for 1, ABC for 2, 3, 4, and 5 up to the 96.50, as I pointed out before, as being a bit of a door stopper. So with that in mind, we're looking at, you know, being short in the euro US dollar, the AU US dollar, and even the euro yen as well. Anyway, we'll get to those ones as I get ahead of myself. The euro US dollar, once again, I haven't labeled this as a triangle here, and it's certainly possible to do that as well. I just want to keep it sort of simple for the time being, but the main point is we've always known that this is a corrective pattern because of this particular structure here being 3 waves. Whatever happens over here is is part of that sort of corrective pattern. But once again, as I just mentioned with the US dollar index and chucking a spanner in the works, so to speak, it is possible that this can be a B wave here and a C wave over here to complete wave 4 over here, and this is a 61.8% retracement level here. Probably past that a little bit, but that's it. So look, just putting it there, I know that's a little bit sort of annoying, but you know, that's the thing with Elliott. You've got to keep you got to keep all the counts on the table. Now, on the downside of all of this, this level in here, this 1.2, 112 here, is really important in regards to the trading levels, because it is part of group 1. It's the pivot within group 1, and group 1 is simply 1, 2, and 3. And once the pivot number 2 here becomes the retested resistance, then the market seems to get trapped and then gets pulled down to the closest largest number, which is this one here. And of course, we're expecting a low below here anyway, but it's just nice to have that pivot, always number 2, no matter what degree of trading levels that you're looking at, as a retested resistance, because then it just gives you a little bit of, once you get used to it, it just gives you a little bit of confidence that that you're heading in the right direction, and those orders that you got on will be a little bit safer. So that's what we're looking at here, and we can see here that it's interesting here because first of all, we've had the move come down, and we've got our bounce off the level, and you're probably more used to having a bull market classic trading levels pattern at a level, but this is one in a bear market here. So really, we've got this reference point here now because we never chase the first one down. We need a reference point, and we've got that reference point now. So this is the one that you'd want to be like shorting from this point here. If you're not already short, that is, or if you're looking to add to positions, then that's a nice place to do it. The Australian US dollar is the same as well. And what I mean by that is that the corrective pattern that we've been looking at through here has been the same as the euro, same but different. And we're seeing this come off its high here now as the A, the B, and the C wave here. So we're on track to go lower ground here. The RBA have got their minutes for their meetings today as well. The general consensus is that they will knock some basis points off the rates, but you know that's always a guessing game. What I like about this situation here so far is that we can see that the 78 here now, you know, we've come down, we've bounced off it, we've come through it, and we've gone back and retested that now. Do you know what I mean? So we've retested that particular number, and if it takes that low out there, then that's the trigger to short this one. Okay, so that low's at 77.55, which is good because we would also use the 72 there as well. I might just go in a little bit further than this as well, just one more if you don't mind. Okay, so this was the reference point that I was looking at here, but we've got this beautiful number here, 77.72 here, and we can see that that's becoming here in this process the retested resistance here. So essentially we could look to short this low here rather than this one here. Okay, so that's good. The pound Aussie now, look, I'm a little bit unsure about some of these crosses at the moment, so we just need to be a little bit mindful. Now in this particular case here, this pattern here that I'm looking at here, you can see that it's got overlapping wave structures, meaning this low is you know, overlapping this high and so forth. So it's a very sort of well, it's a very corrective pattern going up here. How big will it get? I'm not sure. This move from here down to here and coming back to these levels here is the 61.8 retracement level. So it can fail here, but we don't have a lower high just yet from this triple top here. It can fail from here. So if it takes out this low here, then short it. If it finds tested support on 198, then be long. Okay, that's all I can really say about that, because I've gone through all the patterns and it just leaves us with a balanced line to look at. So long on 198 of tested support and short below this one here, this low here. The euro yen, the euro Aussie, this one here is another little tricky one too, in line with the pound Aussie as well. Now, we just need to be careful which side that we get on. It is sort of interesting because this market is working itself into a particular corner. And what I mean by that is that we've had this move down through here, then we've had our sort of, you know, 61.8 retracement level here. The market's moved back down here, checking demand down here, gone back up, check supply here. You know, the 60 odd percent, come back down here, is bang on the 61.8% here. So really it's kind of like a little triangle in a way, but really what's going on is that, you know, it's check demand, check supply, check demand, check supply, check demand. So it's going into, you know, it's really diminishing into a particular point. It'll come out of that space. Now, we just need to sort of understand that a little bit. So from this move coming down here, we're right on the 61.8% mark here. We have counted this rough looking pattern down here as an A and a B and a C wave here. So we were looking for a move back up through here, and we are getting it, but is it worth trading? You know, how much faith do we have in it and all those sort of things? Well, first of all, we would be, if we traded along here, we would be trading against the main trend here. So that's dangerous within itself. When we let's go in here a little bit further. Now, this this little move here going from this, I mean, this is the actual low here, okay? So, well, close to it. So we do have 5 waves up here. So, you know, technically we have 5 waves up here. We would be looking at this as an, and that's pulling, yeah, an A and a B and a C here, and then we could move up from that point there. So if you see that, then be long on 144 after you got this other move down and so forth. But one of the problems here is that this move, I have to label this one down here as wave B here, this one here as wave A. And the reason I need to label this as wave B here is because we've got 1, 2, 3, 4, 5 here for an A wave, A, B, C for a B wave, and this is some sort of skewed C wave here. So in a nutshell, this B wave here is in a reasonably clear 3 waves. So it makes this an A wave, a B wave, and a C wave up here, pulling back up to this circle here, which is always the 61.8% on top and the 50% below. And this move down here is the 50 and the 61.8 from this point here. So it is working itself into a diminishing point here. So yeah, well, somewhere up here you could go long, and perhaps somewhere even lower here. I mean, there will any move down here, of course, will, if we are going in a bearish mode here, which I think that we are, then any move down through here, we would be looking at this as 1 and 2 and 3 and 4 and 5. So we'll get an A and a B and a C here, and then down from here. So it's working itself into a corner, and this is a balance line through here that we're working with. So I think it's still going to take a session or two before we can actually say that, you know, with confidence that we have a direction for this, rather than sort of getting into the guessing game of the count. But as it stands here, this count here is best as an A and a B and a C, and should work lower from this point here. Okay, so I'll leave that with you. I don't think the setup would be over here. Once this market moves down here and then moves back up in a corrective wave, then we can start looking further down through to here. So we need to get those lower highs. We need to get an impulse wave here, a corrective wave here, and so forth. So if I'm wrong, then this high will be taken out, and you need to be long at that point there. So we do have this number here, which is important, the 144. So maybe 144.20 here. Normally we would be long on 144.30, the top of group 1. 3 is always group 1, so we'd be long on that. Okay, moving on to the euro yen here. Now, this is very much like the euro US dollar, this pattern, this particular pattern here. We know that this is a corrective pattern here. Once again, this is and should follow the euro lower. But once again, this move up through here is corrective. This move coming down here, it also reminds me of being bullish corrective. It's got overlapping wave structures, and this now is back at the 61.8% mark here as well. So it's possible, like I explained with the US dollar, it's possible that we've got an A and a B and a C wave still coming up to finish the 38.2 retracement level, and then down from there. So really a lot of care needs to be taken here. Once we've got group 1 here, so we know that the pivot in group 1 is 132. If that becomes the retested resistance, then we know that we're down from that point there. Anyway, let's just drill in here, and you know, we're looking at it as a bearish mode, and it is edging lower. So just looking at this little rally in here, I mean, this is the 50 and the 60% retracement level, you know, of this move up here coming back here. But you can see my concern is that, you know, we're not looking at impulse waves down here. These are all corrective waves here. And if we do start to get 5 waves up off this low here, which I'm going to explain in a moment, then we're going to get an A and a B and a C, and then we'll go up from that point there. But we'll look at this in both ways. We'll look at it as a corrective rally, where it can move up to here and then just fail from that point, and also as a 5-wave structure. So you will know in due course, if you observe what we're going to look at next, as you know, as the pathway for this. So off the low here, if I can just go back here 1 second, this wave 2 is what we're going to focus on first, and it should be in 3 waves, and it should be a corrective rally. So from this low here, we'd be looking at this as the A wave here, the B wave here, and then 5 waves up for the C wave, which would be 1, 2, 3, 4, and 5. And that would make wave C of 2 there. And it doesn't have to move very high, it just really needs to move just above here somewhere. So a little move up here, and if you can count this out here, we're looking for 5 waves here, and then failing from that point and then moving lower from this here. So that's what we're looking, that's our primary count in line with the euro US dollar. If however we get a more positive pattern emerging, it would look like this. It would look the same here, but would have wave 1 and wave 2 here. It would still have the 1, 2, 3, 4, and 5 here, but it would be the 3rd wave there. And then we'd come back for the 4th wave to the 4th wave of 1 lesser degree, which would be here, and then we would get 5 waves up. Okay, so we'd be looking for 5 waves up at this point here. And in a bit of a nutshell, if I use, just to get this on a more, just find a chart here, just this one will do. So we'd be looking at 1 and 2, and then 1, 2, 3, 4, 5 for the 3rd, back for the 4th, and up for the 5th. So if we get 5 waves here, then we'll get an A and a B and a C here, and then we'll be moving on to the long side from that point right here. So it is important to understand this little structure here. At least we know where we're, where the line in the sand is drawn, and we know where we're right and we're wrong, and it helps us manage things a little bit better. But as it stands, we're looking for a move lower from this point here, not this one. Alrighty, well that's it. So I know we've got the pound yen to go as well. So now the pound yen, this is just the weekly chart here, and all I want to point out here is that we are looking for a short position here, and in that short position we'll look to short the weekly low. Now this is all of this week's here, so you can see that it's a doji, basically equal buys, equal sellers, all those sorts of connotations, but we're looking for a short trade, so taking this low out here would be part of that process. So we can look at that 184 area there as a short trade with a stop above that, and we'll just tag it to the downside. In terms of the actual structure, we're looking at the 61.8 retracement level up here. It's been up here for a week or so, a bit longer, but we're looking for that to roll over. But we need evidence that it is going to roll over and not just consolidate and move higher. We can see that it is starting to creep to the top here. So we know that there is selling pressure in amongst there. In terms of the wave count, we've been counting to the upside, so we're looking for the 5th wave there. But to break that down a little bit, we're looking like this here. So from wave 4, and even yesterday we were looking for 5 waves up through to here. And we were looking at 1 and 2 and 3 and 4 into here, and then 5 up to here. But we can see how big 4 has got here, still a corrective pattern, and still can make a move higher here, and giving us overlapping wave structures here as well. So it is, it is displaying weakness. This is the 1 and the 2 and the 3. And yesterday we were looking for wave 4 with a wave 5 to push up here to new high to finish that. But now I need to put that, and that could still be the case here. That could be the wave 5, but I just want to, get a breakdown from here. So we know that the 184 area on the weekly doji thing is a possible short area there. So if we can see this collapse from here, then you know where you are from that point. And the weekly robo is a really good way to actually stay in a trend. So, but still, what we're looking for now is we just want this to complete. It may not complete here. It could fail from a 61.8 retracement level from this thing here back up here, and then fade from there. At least you know where the short is here. Otherwise, while it's above the 184, it can have 5 little waves up there and then fail from there. Alrighty, cheers. Thanks for tuning in.
What's going on, traders? Welcome to part 2 of the pound Australian dollar technical analysis. In part 2, we're going to be taking a look at the daily chart as I wait for a confirmation signal to get long on this currency pair. Remember last week we did see a inverted hammer form, which is a role reversal signal. It is a warning sign that the bearish momentum may be subsiding and that there will be a transition period from a bear market back into a bull market. So I don't like utilizing that signal as a reason to buy. I like using it as a warning sign, and then since it did occur on the weekly, I will then drill down into the daily and find a confirmation signal that not only confirms the resumption of the bull trend, but also confirms the inverted hammer as a reversal signal. So with that in mind, let's jump right into part 2 of Pound Australian Dollar Technical Analysis. As we start on the daily chart now, I'm going to be utilizing the bar replay tool on eSignal, which lets me go candle by candle, day by day, which then allows me to showcase how I not only analyze from a technical analysis point of view, but also from a mental analysis perspective as well. Remember, we always need to be aware of what the party counter to our position is thinking. It's very important in terms of managing a position as well as entering a position. So with that being said, let's start right away. First bar being Monday, January 19th, 2015. So on Monday, January the 19th, 2015, we did end with a doji candle right at this key supported level of 1.83.5. This told me a couple things. We can see that this doji did react just above this 1.835 level. It reacted at this 200 EMA, and it also showcased some deceleration, which is an indication of bearish momentum slowing down. However, we were sitting below this trend line now. Notice how we fell below the trend line on Friday the 16th, and now we were rejecting the backside of this trend line with the doji. And if we measure the last major swing lows to the highs we saw just above 1.92, we were also rejecting the 0.618 retracement. Notice how we were sitting just below it. So from a technical perspective, I did not see this as a decent signal to buy. Even though it was a doji at this key supportive level, you could have argued for a breakdown to the downside or a rally off this 1.835 level. So this was a good opportunity to utilize the wait one more day tactic. Remember, if we get a bullish engulfing or a bearish engulfing, either way, we can then utilize the intradays to take advantage of that. So this is a good opportunity to wait one more day. From a mental analysis perspective, we have to remember now that this dip we saw on Monday did trigger in any short traders who are looking to take that inverted hammer short. As IP students, we know not to sell at the bottom of a move. However, newer retail traders don't understand price action, they don't understand technical analysis, and they saw that inverted hammer as a reason to sell. Even though this doji was not a good signal for us to buy into this market just yet, we have to remember that any short traders who were getting short at the bottom of that inverted hammer were now triggered in due to this doji occurring. So keep that in mind. So now that we waited one more day, we can see we did get a bullish candle that rallied back above this key trend line. It rallied off the 1.835 key supportive level. It also rallied back above the 200 MA. What this is telling me now is that there is definitely bullish presence at this 1.835 level. And any traders who got short around 1.84 may be a bit concerned just due to the fact that we had a lack of follow through to the downside and that the bulls pushed price back above not only the 200 MA but also the key trend line. In terms of this being a buy signal, not enough confirmation for me yet. The key area I was worried about was this 1.86.5 resistive level. Notice how we got a significant push off this level back in the beginning of October 2014. We got a push off this level in the beginning of November, and we also had a reaction very recently last week on the 14th and 15th of January as we rejected the 1.86.5 resistive level and the 50 EMA as well. So I wanted to see this key resistive level cleared before deciding to get long. So again, I was waiting one more day. I wanted to see where price took us. So the next day on Wednesday the 21st, you can see we got a massive bullish engulfing candle that not only closed above this key resistive level at 1.86.5, but it also closed above this 50 EMA. That is a big technical signal in terms of bullish strength. Closing above both the 50 EMA and the key resistive level of 1.86.5 requires a lot of momentum. So now we have to think, where did this momentum come from a technical point of view? It came from the traders who got short around 1.84. who are starting to cover their position, which is going to add fuel to the fire in terms of bullish strength to the upside. Remember, this first warning sign on the 20th to any short traders was a good reason to start getting out of your position. And then this candle on the 21st, almost all short traders should now be out of their position. The last remaining ones who had their stop above the inverted hammer at 1.88, this last swing high, those are the last traders to be in their position on the opposite side. So if 1.88 is taken out, any short traders would definitely be out of their positions, as this is where the majority of stop losses would have lied. This would have been the safest stop for selling the pound Australian dollar. So once this candle on the 21st formed, that was a direct indication to me to start looking at the intradays for any possible signs of support at this 1.86.5 level. Also, I wanted to see how price reacted to the pivot point at that time, and if we were able to remain buoyant above this key resistive level of 1.86.5 turn new support, and if we could also sustain above the 50 EMA. So with that in mind, I want to now jump down to the 4-hour chart and show you guys how I enter my position utilizing the pivot points, utilizing what we teach in Platinum to get a great risk reward on a trade and milk out as much profit potential as possible. Taking a look at the 4-hour chart now, I want to showcase to you guys not only how I found my technical signal to enter my position, but also how I utilize the pivot points to get the slimmest stop loss on my trade and milk out the biggest risk to reward ratio. Any swing trading students who are viewing this video, don't get too caught up in the mechanics of the day trading. This is utilized as a timing aspect for me, as I did use the quarterly, the monthly, the weekly, and the daily before I drilled down into the intraday charts to time my entry. I had to use those longer term charts to find my overall bias, to find my sentiment, get the trigger on the daily, and then I jump down to the intradays to time it. So those new to this, don't get too caught up in the mechanics. Just pay attention to the price action, how I'm looking at the market from a technical analysis point of view. Any Platinum students will know what I'm talking about, but again, swing traders, just pay attention. I'll jump back out to the daily chart once I show you how I time my entry. But this pound Australian dollar trade could have been entered via a standard swing entry. You would have just had a larger stop loss on your trade. So with that being said, let's start drilling down to the 4-hour chart. So the first thing I want to point out that we couldn't really see on the daily chart is this pattern of lower swing highs. If we add in this trend line, you can see on the daily chart we have been putting in lower swing highs ever since bouncing off the top of the ascending channel just above this key resistive level at 1.92. So looking at these lower highs now, you can see we did break out of this pattern on the 21st with that large bullish engulfing candle as we broke the pattern of lower highs, breaking above this key resistive level of 1.86.5, as well as breaking above the daily 50 EMA and the 4-hour 50 EMA. So once I saw that, I wanted to see a pullback of this large bullish engulfing. You can really see the size of it on the 4-hour chart. I wanted to see a pullback of this bar, retesting this broken trend line and retesting the pivot point as well as the 50 EMA. So as we start to go forward in time here, we can see that the new pivot point is at 1.86089, so roughly 1.86 even, with S1 being at 1.848. This does coincide with a possible retest of the backside of this trend line, as well as getting in around 50% retracement of this bullish engulfing candle pending a low test, doji, etc. As I saw that the pivot point was going to be a area where we may see a decent pullback, I knew I wanted to get long. So again, I waited. I wanted to see how we reacted at that pivot point. So looking 4 hours ahead, we got a bearish candle. Not really enough to convince me to get long. I didn't want to take a blind pivot entry with a stop below S1. I wanted to wait for a technical signal as well. Again, I wanted to see a retest of the backside of this trend line as well as the 50 EMA. So again, waiting another 4 hours, you can see we did get a perfect low test candle right at the pivot point, closing above the pivot point, rejecting this 50 EMA, rejecting this minor 4-hour resistance around 1.86. Tons of confluence here in order to get long. Remember, this matches up with our weekly and our daily view as well. So again, this is utilized as a timing entry. And so once I saw this low test candle, I knew I wanted to get long once this candle closed. So I set my entry at 1.86, my stop below at 1.85. The reason I stopped clip my trade a bit was just due to the fact that I had the support of this large bullish engulfing candle, we had a technical signal at the pivot point, and my stop was still well below the 50 EMA, which also added additional support. So this gave me a 100-point stop, which is a bit large. Normally I like 50-point stops or less, but it was better than taking a standard swing entry, and it allowed me the most ideal timing as we did break this 4-hour trend of lower highs. We came back with a perfect retracement of this bullish engulfing candle, but rejected the pivot point, rejected the 50 EMA, rejected this minor resistance at 1.86, and we had a technical low test candle. So pretty much the perfect storm on the 4-hour chart that supported our daily view, it supported our weekly view of the inverted hammer being confirmed, and it supported our monthly and quarterly views as well. Jumping ahead now, we can see we got liftoff right after that low test candle with a large bullish engulfing candle. So I did set this entry on the 22nd after seeing the low test candle, stop at 1.85, and once I saw confirmation, I knew it was time to start to jump back out to the daily chart, jump back out to the weekly, and start managing my trade through the daily and the weekly. Once I found my timing on the 4-hour, I wasn't too concerned about the rest of the price action, as I wanted to monitor that through the daily and the weekly, as that will provide me with a better outlook as to how to manage my position. That was a quick view of the 4-hour chart, how I utilize the pivot point, zooming into the intradays. I know it's a bit advanced for any newer swing traders, but any platinums should be able to pick this up very quickly. And any swing trading students, just utilize this as a quick lesson, a quick preview of what to expect in the platinum lessons. So once I got my entry at 1.86, my stop at 1.85, I zoom back out to the longer term charts, and I'll show you how I manage my position all the way up to the key resistive level of 2.0. Zooming back out to the daily chart now, we can see that on Thursday, January the 22nd, after we timed our entry at 1.86 with a stop at 1.85, we did end the day with a very supportive low test candle that not only was rejecting this old resistance at 1.86 and a half as new support, we also remained buoyant above the 50 EMA, and we were getting dangerously close to the 1.88 level, which really was the last safe haven for any short traders on the pound Australian dollar who saw that inverted hammer as a good area to sell. So keeping that all in mind, that was very supportive in terms of keeping my position open. The timing was spot on in terms of the low test candle at the pivot point. It was a great retracement of the daily bar we saw on the 21st. So once I saw this candle, I had lots of good faith in terms of this trade turning back out to the upside. So we want to see what happened on Friday. We can see we got a massive bullish engulfing candle on Friday after so many traders saw that supportive level of 1.865 now acting as support with a nice technical daily signal. This low test candle rejecting the 50 EMA as well. That was a lot of confluence to take this pair higher, and you can see we got a massive bullish engulfing to end the week, taking out 1.88, which actually added to the momentum of the upside move. Notice how we barely backed off the highs on Friday the 23rd. Those swing traders asking how they could have got in their position. After the candle formed on the 21st, you could have taken a standard swing entry at 1.88 with a stop at 1.86. It was a rather large stop loss for a standard swing entry, but you could have still milked out a decent risk to reward. So keeping that in mind, any swing traders could have easily entered this position. Just know that your stop loss would have been fairly wide, but you could have still made a decent profit. So with that being said, once we finished the week with a large bullish engulfing candle on the 23rd, I then want to zoom out to the weekly chart and analyze what the weekly's telling me and start managing my position through the weekly chart. So let's jump back out now. So jumping back out to the weekly chart now, once we ended the week with that large bullish engulfing candle on Friday, January the 23rd, I wanted to see what the weekly chart was starting to shape up as. You can see we did end the week with a massive bullish engulfing candle, wiping out any bears in this market as we closed above that 1.88 level, which was the last safe haven for any short trader stop losses. It confirmed this inverted hammer as a roll reversal and a bear trap. So what that told me is to continue to hold my position. It showed a massive amount of bullish momentum, and that opened the gates for this 1.92 key resistive level as the next target for the bulls. Any conservative traders could have set a profit target now at 1.92, as that was the last major swing high. However, just due to the fact that we rallied off the 0.618 retracement, The bear trap and inverted hammer was confirmed. We rallied off the bottom of this channel, and we rallied off this trend line as well, the third drive off this trend line. So that there was a ton of confluence in terms of the bulls keeping up the momentum and having 1.92 be the next target. So now that I timed my trade on the 4-hour, we ended the daily well on Friday the 23rd, and we ended the week with a massive bullish engulfing. I'm now going to manage my position via the weekly chart. The reason being is I don't want to pay attention to these daily moves, as I know 1.92 is the new resistive level that's in our way. There's nothing standing in our way between this key level at 1.92. This gives me supreme confidence in holding my position. Instead of setting a profit target at 1.92, I wanted to see how price fared at this level. I saw this as so much momentum, and I had a hard time believing that we were going to find bear step in at 1.92, but it was still a definite possibility. I would much rather see how the bulls fared at this level. Worst case scenario is we got a high test candle, and that would have been a great technical reason to exit my trade. So I had faith in the bulls. I wanted to see how they fared, and if we closed above 1.92, if we zoom out, the next key resistive level is not until this psychological level of 2.0. Notice how it was support and resistance back in 2009, very key level. So I wanted to see how the bulls fared. I didn't want to cut my winner short by adding a profit target at 1.92. So jumping forward 1 week now, you can see we closed above 1.92 with a strong bullish candle. That shows a lot of momentum to the upside and was another reason for me to continue holding my position. One other factor of confluence is if we add in this Fibonacci level measuring the last major swing high for the week of December 15th to the swing lows at 1.83.5. Notice how we cleared the 0.618 Fibonacci retracement zone, which is a huge sign. Reason being is if price stays contained within the retracement zone, it will often lead to lower highs and a resumption of the bear trend. The fact that we closed above the 0.618 retracement and utilize it as new support, and we rallied above 1.92 are all huge bullish signs that we're going to continue higher. Next weekly stop being this 2.0 level. So that gave me complete faith to continue holding my position. In terms of moving my stop loss at this point, all I did at this point was move my stop from 1.85 to 1.86, which brought me to break even. Again, I'm giving a massive amount of room to breathe on this pair, as I want to see how much this bullish momentum will carry us. The fact that we closed above 1.92 at this point gave me supreme confidence to hold my position, and I didn't want to move my stop loss too close. I wanted to give it plenty of room to breathe. So again, I waited 1 more week. You can see we then found support at 1.92 with a nice supportive candle. It was a bit indecisive as we started to back off the highs a bit, but the fact that we now found support at 1.92, basically confirming this old resistance as new support, made me move up my stop loss to the bottom of the weekly bar the week of January 26, 2015, locking in some profit here, locking in 2%, moving my stop to 1.88. I felt the fact that we found support at 1.92 for the week of February 2nd, 2015 gave me enough confidence to move my stop up a bit, still having protection from 1.92, having protection from this bullish engulfing candle, still far away from price, still plenty far away from price, but again, I wanted to give massive amount of room to breathe as I managed this position through the weekly chart. So again, waited 1 more week. We can see we did tap that key psychological level at 2.0. Again, like I keep telling people, these weekly levels are hit over and over and over and over again. Notice how we break 1.92. We blast through any minor daily level, and we head to the next weekly psychological level at 2.0. So these levels are hit systematically all the time. That's why I always recommend utilizing the longer term charts for managing your positions, as you won't get faked out as much as you will on the daily charts. There's a lot of noise still on the daily that could lead you to prematurely exiting your position. So once the week of February 9th, 2015 ended and we tapped that 2.0 key level, we did seem to lose a bit of momentum. Notice how we didn't blast through this level like we did at 1.92. So there is a bit of seller stepping in at 2.0. And I saw this as a good opportunity to move my stop to 1.94, which is just below this candle for the week of February 9th. The reason that I moved my stop to the 1.94 level below the weekly candle for February 9th, 2015 is the fact that we are now approaching this trend line again, which can act as resistance. We did get a bit of a reaction off this 2.0 key resistive level as we did back off the highs a bit. So we could easily see a retracement from this area back down to around 1.92. So I want to move my stop up at 1.94, which does lock in 8% profit for me. The other thing I want to point out as well is if we measure the last major swing lows at 1.83.5 to the highs at 2.0, you can see the 0.5 to the 0.618 retracement lie around 1.91750 to 1.898. Even if we do start to break down and my stop does get taken out at 1.94, I will most likely have ample opportunity to get in again on this pair and then take another long position back to the upside. However, I do want to move my stop up to 1.94. That way I can lock in a decent amount of profit. If we do get the pullback, so be it. I get taken out at 8%. I can always get long again at 0.5 to 0.618. But the reason I don't want to keep it at 1.88 is if we do start to find resistance here and then we break below the 0.5 to 0.618 and break below this channel and I get tagged out at 1.88, that would be a very poorly managed trade in terms of having a possible 8% at 1.94 compared to 2% at 1.88. I want to start locking in profit as we are getting a bit extended. We did find a rejection at 2.0. We do have this trend line. So just something to point out is even if I got stopped out, I can always get back in. And that's something I really want to make clear here. So if we go to the end of this most recent week for February 16th, 2015, you can see that we did get the first bearish candle in 4 weeks, closing back below this trend line. Notice how last week we did close above it, and then we subsequently fell below, creating a bit of a false breakout of this key trend line. We may see two scenarios happen. We either blast up higher from this inside bar, or we start to retrace back down to this 1.92 level. Again, pointing out the Fibonacci retracement, you can see how lies perfectly with this key broken resistance at 1.92. Also, it lines up nicely with this key trend line and the bottom of the channel again. I may very well likely be taking out at 1.94 and taking out at 8% profit. If so, I will then look at this 0.5 to 0.618 retracement zone as a possible new area to find a higher low. A rejection of this 1.92 as support once again, rejection of the Fibonacci zone, and rejection of the bottom of the channel and this key trend line. Tons of confluence in this area. So I would not mind getting taken out at 1.94 as 8% profit is a huge trade. And again, if we think of that as $1 million account, that's 80 grand in your pocket from a nice, easily managed weekly trade. So again, you have to trade your account like $1 million account. It may not seem like much on a $1,000 to $5,000 account, but all you need is consistency. Once you build consistency, you will have money come towards you, I promise. So keeping that in mind, an 8% position is huge. I don't mind missing out on a bit of profit because I wanted to see how we fared at this 2.0 level. So either I get taken out at 1.94 or we blast higher, and then I'll start to manage my trade once that happens. But a pullback, I would not be surprised. However, I don't want to keep my stop at 1.88 because again, if we break below this Fibonacci zone and I get taken out at 1.88, that would be a very disappointing 2% on a hugely profitable trade. So that brings a close to part 2 of the Pound Australian Dollar technical analysis. I hope you all enjoyed it. I know it was a lot of information. It was a lot of back and forth between the 4-hour charts, the daily chart, the weekly, and then back down again. So if there's any questions, please don't hesitate to ask. I know it's a lot of information. So that brings a close to the Pound Australian Dollar technical analysis. My stop remains at 1.94, and I'll keep you all updated how I am currently managing this position. Have a great weekend, and I'll talk soon.